Thank you, Pascal. Good afternoon, everyone, and welcome to the panel. I think we're in for a treat. The experience is quite broad, and I like the female representation. And thank you, Elvis, for then balancing it. So I think we've heard all morning about the importance of ESG in business resilience and sustainability. And Fungai and Mr. Ndamba did stress that there's a lot of legislation. Okay, not a lot. Well, there are a lot of frameworks, but as Zimbabwe, we are also leading in terms of legislation. So I've got real questions for the panel to say, are our organizations genuinely embedding ESG into their strategic core, or are we still treating it just as a compliance exercise? And as Pascal said, would like to hear the case studies, would like to hear the challenges and opportunities. I think Mr. Ndamba had an African proverb, I hope I don't butcher it, but it says if you want to go far, go alone, but if you want to go further, go together. But the point is, it's better if you actually go as a team. So I hope we get to shorten the learning curve. It's good to step on the shoulders of giants and foresee what we might need to deal with as we get into the process of actually making sure our businesses are sustainable. So I'd like to start with Madeleine, and particularly from your experience at First Rand. So First Rand finances both green and high carbon sectors. So how do you practically navigate the internal trade-offs between fossil fuel clients and your sustainability commitments?
Okay, I think this is this on. I think this challenge is kind of front and center for finance institutions. Um, but I think First Rand is a little bit down the way already in having made this decision and incorporated a strategy how they want to address this. So in South Africa, we have, as I've now heard you have in Zimbabwe as well, an energy crisis. We have gone through a period of huge load shedding and a significant impact on industries because of the fact that energy couldn't be provided sustainably to businesses. And so, as a result, the bank had this choice because South Africa has always been very dependent. In fact, the largest part of our baseline comes from coal. And there are very strong political feelings that we can continue going on with coal forever. Um, but it is significant and we cannot deny that. So First Rand had the option to either walk away completely from coal overnight, leaving the state-owned entity and businesses in the lurch because we, as or they, as one of the four largest banks, financed the state-owned entity that provides energy. And I think at that point, the decision was made that we don't want to do something reckless like that because the country is dependent on energy, but that we wanted to bring it into the strategy that however we will be reducing our exposure to thermal coal and to oil and gas, we will be focusing on transformation and transition. So it's almost a condition of financing that if you are in the high fossil fuel sectors, which they call the brown sectors, then you have to show the bank that you have a transition pathway, that you've made some commitments, and that you are reducing your emissions. And it's usually favored if there's also a renewable energy product or project that can be financed by the group. Over and above that, they set a target of divestment from thermal coal and oil and gas. And many, many factors were considered, part of it being stranded assets, especially in the gas industry and drilling for gas. They're very hesitant to touch the nuclear sector, which is not completely renewable, but I guess better than coal. But this is the transition pathway that they are on. They have a firm commitment to balance, to tilt their balance sheet from brown to green. And they've also used the opportunity quite nicely to finance solar products and renewable energy so that they are balancing their own balance sheet. Hopefully, as a reflection, as banks always are, is of the economy and the balance sheet of the country.
Well, thank you so much for that. Quite an important point, and I think someone raised an issue about do we do away with fossil fuels, and the first world really did benefit, and it's important to know that. It's important that we balance environmental ambition and socio-economic realities. And just as a follow-on, maybe, what does the tension look like when it comes to decision making? Who wins when ESG priorities and short term profits collide?
So, when Pascal read my bio, I think it gave away that I'm very old and I have lots of years of experience. So, if you asked me this question about 10 years ago, I would have said the profitability and the economics always wins. I used to have some of my best fights around the table with investment bankers. I'm not an accountant by background, I'm a scientist, just to say that on record. And it was their incentives, obviously, that was driven by commissions and profits that they were making. And obviously, the large commissions were in the heavy or the hard to abate sectors and the heavy emitters. Today, the picture looks completely different. It is now part of their incentives to finance renewable energy and sustainable projects, and that is where their commission comes from. So they can still, to a limited degree, finance high emission sectors, but they don't get the commissions that they used to. So, in short, I think that the environment is winning. And that not just because it's a financial incentive, but because people realize, and especially young people in the organization, young accountants, young quants, are realizing the importance of investing in the future. And so they always ask sustainability questions. And I think banking in itself has changed significantly from just making money and being the bad actors in the story to being advisory, being partners, and looking at the solutions and sharing prosperity to society as well.
Thank you so much for those insights. It's interesting to see the shift coming through, and also still the support that is there for people still dependent on fossil fuel, but the benefit more of actually committing to renewable energy. I'd like to ask climate risk, like Fungai highlighted. Oh, it's still for you. We'll get to Fungai. So, climate risk stress testing is gaining traction in the banking sector. Within First Rand, has this process actually reshaped lending policies? I think it follows on to the first question, like you've highlighted. And is it still largely a regulatory formality, or it's something that's actually happening across the banking institutions in South Africa?
So I think it is happening across the institutions. Interestingly enough, the South African Reserve Bank issued about 3 years ago an instruction to do a stress test on drought scenarios, which was interesting. And I think we were not as mature. We didn't take into account, maybe we didn't have all the data at the time. And it looked as if the impact would be insignificant. And I was very frustrated by that because I obviously wanted to see a big bang in the scenario analysis to prove that it's going to have a huge impact. We did a similar stress test last year, and it was totally different. The impact on the bottom line and on credit was significant. The loss profit ratio was out. There was definitely an impact, and we had since integrated into the credit decisions KPIs both on transition risk and on physical risk, and they've developed a physical risk tool that all of the credit people can use to do an assessment of future scenarios of climate. And particularly in the physical risk space, looking at extreme weather events, droughts, wildfires, beach erosion. It's fascinating. So basically, we've used the information from the Science Institute of Research, and we've overlaid client information. So we've got GPS coordinates of every single client that we have and every mortgage that is financed. And we looked at that so we can actually see in 20 years' time, in 30 years' time, is it a good idea to finance this mortgage because it may disappear in the sea? Or it is in a very dry area and it's an agricultural holding, and they will have to diversify. That does not necessarily mean that we will not finance. It means this intervention that I'm telling you about, the advisory part coming out, and relationship managers going out to the clients and giving them advice on climate smart agriculture, on regenerative agriculture, on resiliency, especially diversification of commodities. And so there's much more of an intervention and a prevention, and building resilience is the language, than rather than walking away. So what they haven't yet done by the time that I left them is they haven't instituted negative pricing yet, but they're probably about to. So on the positive side, in sustainable finance, you will get a beneficial rate if you do something that is sustainable in the bioeconomy space or renewable energy, and it's usually 1 or 2 bips. In the negative space, I think the next step for the banks would be that when they do their due diligence and they actually bring into account physical risk and transition risk, that they will negatively price transactions that are not favorable in the long term.
Quite an interesting take. So when you started talking about the data and thinking about the processes of then starting the climate stress testing, I thought, what a lot of costs in my mind. But I also liked the business opportunities that you raised in relation to potentially differential rates of lending, and also the opportunity of advisory, which then comes with some of these activities that you're carrying out. I think just to close off, I will give you an additional 30 minutes at the end, so feel free to also listen to the interactions from other panelists if you'd like to add anything. But just to close, South Africa's inequality and unemployment crisis makes ESG decisions politically sensitive. How does FirstRand design ESG strategies that balance environmental transition with social equity? I think this is a big issue in Africa, to say, yes, we want to transition, but there's the social equity side. How do you manage that?
So in South Africa, the big incentive is a just transition, meaning that the transition has to be there, but it has to be just. So whatever you do in the transition pathways, you have to make provision for employment issues, creating new jobs in the green industries. And in fact, we were involved in industry in doing transition pathways through the National Business Initiative in South Africa, developing pathways that had exactly that in mind. And you'll hear when you hear any conversation about the transition, it's also that it's a just energy transition, and it's the just transition in terms of sustainability. So I think that companies realize, and specifically the banks, that the environment and climate change is critical to society. They are so closely engaged, and that society is deeply dependent on ecosystems and on water and many other factors in the environment. Ecosystems and food is the basic one. And so there's a big and a deep societal impact, which is acknowledged. And in fact, I think when you have the argument, the just transition is conditional to having any further conversation. So I'm quite happy about that society is central to whatever decisions are made. And if it was a debate a few years ago, I've seen the change.
Thank you so much for those insights. Maybe I'd like to move to Elvis, just following on from discussion and
Yes.
maybe given the
Can I
Kenyan
just
perspective.
can I just add to what Madeleine
Yeah.
said? First of all, Masikati Akanaka. I worked so hard to say that right. I hope I said it right. If not, you can blame it on Miss Sandamba. But yeah, I think banks are not doing enough, at least in Kenya, and don't quote me anywhere. I think as the custodians of capital and the people who determine how capital flows, I think banks can do more in terms of helping us achieve proper ESG integration. I'll give two examples. One, in Kenya, there's an entity called ACON that did Africa's first green bond that was cross-listed in the London Stock Exchange as well. It was a whole big thing. When I take stock and look back from then and now, that entity has not really benefited in terms of, reducing how much banks lend to it in terms of development. So really, there's no incentives in the market for anyone to go green as it stands. And I strongly believe that banks have the capacity, have the key in their hands, banks and insurance companies, to be able to give us that kind of mileage that we need. The second example is on whenever we discuss about products that are geared towards sustainability, especially from an investment perspective, there's always the temptation to make sustainable products look like they are the disabled person. They're painted. We do as much as possible to put up makeup on them to make them look sexy, yet they are an imperative if you think about it. And the fundamental problem is how financial institutions and investors, determine through the net present value computations what is good for as an investment. So if fundamentally then your sustainability products are take into account climate risk, and on this side your traditional products don't, then you see already you are comparing apples to oranges. So it's not a matter of making these products look better, giving them all these tax incentives. I think once we incorporate climate risk into investment portfolios, it becomes what's the word for it? It becomes obvious that climate products will become the next big thing. So I just wanted to add that banks can do more. Yeah.
Thank you for that challenge. And maybe I'd like to also ask you from an accountant's perspective to say how can accountants help bring more rigor to the ESG claims? Because I'm not sure from a Kenyan perspective, but I think banks in most jurisdictions lead in terms of we are actually doing the ESG ESG work. So maybe I would say my direct question to you, Elvis, is as Kenyan firms adopt new ESG rules, many are just reporting what's easy, and many are making the ESG claims to say we're doing something, and they're not particularly focusing on what's material. So, how is ICPAK ensuring our accountants can spot and prevent ESG washing by focusing on issues that truly matter for Kenya, like water security or community impact?
Yeah, that's a good question. I think for me to answer that question, I need to define what materiality is, and particularly from an IFRS SMD disclosure perspective. So the same definition that we've always used for traditional IFRS is the same that has been carried into the IFRS SMD disclosure standards, and that's information is material if obscuring, misstating, or omitting that information will, of course, influence the decision that primary users of these reports will make. So what we're seeing in Kenya is still early days, really. We are in what I'd like to call the ESG hype. Everyone wants to report. Everyone seems to be on board. But what you want to see in our market gradually is that transition into ESG maturity, where now people are doing the hard work. People are putting down budgets to be able to do this work. But on that greenwashing aspect, I think what will happen is I look at greenwashing in terms of three components. The first one is the governance bit. If your board is on board, as most of the presenters have already mentioned, then as the custodians of, or as the people who sign off your general purpose reports, then you should expect that what is signed off is actually something that has gone through board process. The second bit is in terms of internal controls at entity level. What are some of the controls that an entity has put in place? The same way, and I have a background in auditing. So when I remember when we used to go audit, for instance, when you go to audit cash and cash equivalents as a financial statement line item, we used to have a control on bank reconciliations, preparation of bank reconciliations. And we would take a sample of that and see, were they done? Did someone review that? Was it approved? So the same way sustainability information, the same rigor is what will be done when it comes to assurance of sustainability information. And I'm looking forward to that season, because I expect very many people to get qualified opinions. I'm sorry, but yes, it's no longer business as usual, and that's my last pillar, assurance. In Kenya from 2032, we are also expecting to start seeing assurance ranging from limited assurance, then reasonable assurance subsequently. And if you know, and most of the people in this room have probably been audited, there's materiality thresholds, and there's all these things that we normally get into in terms of ensuring the type of opinion that you actually get. So I would say those three things are key components to ensuring that there's no greenwashing to begin with. Finally, a good example is there's a luxury online store. I don't know if you guys have read about this. It's called Shein. From I don't know if it's from China or Japan. They made some interesting claims across different jurisdictions in their websites and in some of their reports, and they were fined as much as $1.4 million in one instance, and I don't remember the figure for the other. But regulators such as myself will start reading these reports even more keenly and challenging some of the pompous, vague terminologies that are used in some of these reports, and we'll be putting you into account and asking you, is this really accurate? Yeah, and of course expect fines.
I like how you've sort of brought in the full business process from the board operations when you're looking at the internal controls and assurance. And maybe, forgive me if I'm stressing the point, but who really should then own the ESG strategy? Dr. Mboweni spoke about strategy, structure, staffing, which gives the idea that the entire business, what do we call it? Yes, so different departments cross-functionally, ESG should be an issue. So my question is, who should own the strategy in Kenyan companies? The CFO, the board, or the sustainability team? How do you expect this to filter down to the rest of the organizations, functions?
Yeah, I mean, people throw stones at me whenever I give an answer to this, but I think finance people have the right tools to, help a good chunk of the reporting that will be required from a sustainability perspective. I know climate people will not be happy, but I think everyone, the correct answer is actually cross-functional. It's a cross-functional process that requires everyone, because if you think about it, if you need HR data, that only sits with HR. If you need procurement data, that sits with procurement. So you need, champions stationed in each and every department that would ideally give life to the metrics that you put in place to ensure that reporting happens. So a cross-functional team is the best approach that I've seen work. However, of course, the board has to have oversight. That one is clear. Some organizations will, of course, looking into a crystal ball into the future, might consider having, a CSO, a CSO role once, of course, ESG matures, and that's what Madeleine, I guess, will have missed because she's retiring. But yes, and in some organizations, you'll find that the CFO will have to do the dual role of being both the chief sustainability officer and the chief financial officer at the same time. I guess they'll have to ask for more salary then.
Thank you so much for those insights. Just to close, maybe on your thoughts. So we did say we want to figure what are the challenges, because I think a lot of people here want to get up and running and make sure that their sustainability is up to the PAAB's expectations. So what do you think are the biggest technical gaps in Kenya's ESG reporting? Is it in the metrics? Is it assurance? And how is ICPAK preparing accountants using standards like your IFRS S1 and S2 to bridge the gaps and drive genuine value creation and not just compliance?
Yeah. Thanks, Hope. First of all, I have to remind myself every time I'm in Zimbabwe that it's IFRS and not IFRS. So in Kenya we say IFRS. Yeah. So in terms of your question and the gaps that we see in our market, I think one of the biggest gaps, and this is ubiquitous across all African countries and indeed even globally, is data. Data availability is a big problem. Scope 1, Scope 2 emissions, for instance, are easy because some of that information is already domiciled within organizations. But when you look at your Scope 3, where you have to now scope your entire value chain, that's where it gets a bit tricky. And that's why the standards have reliefs. For instance, you're not required to report on your Scope 3 on your first year of reporting under IFRS standards, yeah? In terms of the other thing is in terms of buying. Just last week, I was having a meeting. I was in Cape Town, and I was having a meeting with one of the people I consult for, one of the clients I consult for. And the biggest challenge really is to get the tone at the top, the leadership to be on board with sustainability reporting. That for me is perhaps the biggest challenge that many entities continue to face. Convincing people that this is not a cost center, there will be value, there will be return on investment subsequently. That's the biggest challenge I see. And of course, it doesn't help that most finance people do not paint a true story of the business case to the leadership. And I think this is a challenge to all of us in the room, that when we go to our leadership, and of course, it's good that some of the leadership are also inside this room, the business case has to be very succinct, very, very clear. It needs to be seen that it's not a matter of buying new technology and hiring people and all these things. It has to start first from how are we going to benefit as a company from reporting in the first place. So that journey is also tricky. And lastly, I can talk about connectivity. The new standards will require entities to tell a complete story that interlinks financial and sustainability. The kind of reports we've been seeing, especially on GRI, have been missing. And of course, because GRI is impact materiality, is impact focused. But even the other general kind of sustainability information we've been seeing has not been linking back to the financials. So you find entities claiming in the sustainability report that, we will reduce our emissions by this amount. But when you look at the portfolio in terms of the PPE that sits on the books. It's not being depreciated at a faster rate to in line with the targets that they're setting. So that connectivity needs to be very clear to the reader to see that, okay, this is what you've claimed here. Is it reflecting in the books? So I would say those are the three main challenges. Of course, there are many, but those are the three main that I've seen in our market.
Do you have any opportunities, advantages? I say I stressed on challenges.
Opportunities, I think I strongly believe that, at least from an African perspective, this is a chance for us to really think through how we create value and not be in a position where we are chasing one at the detriment of the other. As Madeleine put it and other presenters, I think we need to look at, it's an opportunity for us to focus on future generations and how they will be brought into this chapter. So for me, I see outside of the money that can be made, there's a lot of money to be made in sustainability, if you think about it. And the money is directly linked to the challenges. If there's a data problem, who will solve the data problem? If there's I don't know what kind of other challenges there are in terms of capacity. Maybe it's high time people in this room pivoted and offered services in sustainability. So I think there's a lot of opportunities directly attributed to the challenges. But for me, the biggest is an opportunity to actually create true impact. Yeah.
Thank you so much, Elvis. So correct me if I'm wrong, but from what I heard from Elvis, the people in this room, the financial experts, are the ones that should go and sell the story to top management. So the challenge, I hope you got it, and when we get back, you'll really get a chance to sell the reason behind actually adopting sustainability and ESG practices into the business. And as we talk business, I think I'd like to also ask Karen. Cicada positions itself at the intersection of business growth and sustainability. In what ways can ESG integration be a driver of competitiveness in global markets?
Thanks, Hope. So, okay, can you hear me? Yes. I think one of the key areas that we're seeing ESG driving competitiveness, firstly, is access to markets. For you to be able to get a seat at the table in some of these global markets, the first condition is going to be, are you meeting certain criteria and certification? So that in itself has required us to make that additional investment, whether it's for Global Gap, Rainforest Alliance, META. All those standards come with associated costs, but it's an investment that we're hoping at some point will translate to a premium price. And we're not seeing that at the moment, especially for sectors that are more commoditized. So we are producers of avocados and macadamia nuts. Those are highly commoditized markets. And the challenge at the moment is being able to persuade or to get buyers to see the value in the additional sustainability initiatives that have been taken, and for that to translate to premium pricing. So I think more and more we're hoping to see that sensitization in the market where customers themselves will begin to demand higher standards of sustainability from businesses. I think when we also look at market access for businesses, I think when the EU launched the carbon border adjustment mechanism and deforestation rules, those are already indicators of where global markets are going and the increasing expectations for higher standards, as I've mentioned before. When you look at the EU CBAM, it's going to put an additional carbon tariff on goods such as steel, cement, fertilizers to prevent carbon leakage. But I think for them, it's also to level the playing field for their local producers, for their local industries. And so this is something that initially started off on trial, but effective 2026, it is going to be fully implemented. And the products that they've put forward are only the first of many other products that will be added onto that. So regardless of whatever sector you're in, if your business strategy is to grow into export markets, then this is something that is now more of a commercial imperative to make sure that you are positioning yourself to be able to access those markets. EU's also launched the deforestation rule, which will also ban import or export of commodities that fail to prove that their products are deforestation free. And later on this afternoon, I'm going to dive a little bit deeper into the scale of the problem within Zimbabwe when it comes to deforestation. But you find that, again, global trade, or the landscape for global trade, is shifting. I think when America started changing their trade tariffs, and you've seen responses from countries like Canada also now introducing carbon pricing mechanisms. Essentially, the two biggest emitters globally are China and America. And you find that more and more now, the carbon tariffs are going to position companies that are more carbon efficient to be more competitive in these global markets. And I think that's definitely something to touch on. And again, I don't want to preempt the session this afternoon, but we'll also get into a little bit more detail on what the carbon pricing mechanisms are looking at the moment.
Thank you so much for those insights. And I think I'd like to link it with Dr. Ndamba's presentation. There is definitely some work to be done at an entity-specific level if we want to access the global markets. But when you started talking about deforestation, I was also wondering, is there country-specific efforts that we as businesses, along with the regulators, might need to lobby to make sure that we stay competitive? So just follow on. Cicada operates across diverse sectors, many with fragmented or informal supply chains. In what ways can embedding ESG standards be incentivized more broadly across value chains?
So I like that Kenya seems to, be headed in that direction. South Africa is already there, but some of the things I was going to mention have been touched on. And at the moment, we don't have real incentives for people who are doing the right thing. In fact, there's more penalties and costs to doing the right thing. And sectors that are creating the problem are actually enjoying more favorable rates. And so I like the fact that we're saying banks could take the lead, because from a funding perspective, we need to be able to start to see some sort of sustainability linked pricing within Zimbabwe. Results-based loans, where it's not just about what you've said you're going to do, but let's measure the results and take, and apply incentives on your loans based on actual implementation. So I think, that's at a sector level. At a country level, we're seeing now where, countries are negotiating debt for nature swaps. So you can actually begin to deal with national debt by investing in climate solutions and leveraging on that investment to negotiate these debt for nature swaps. Very few countries have done it, but the fact that some have started doing it shows us that it is possible. And Zimbabwe definitely would benefit from that. It's been a while since I've heard about active bonds or an active bond market in Zimbabwe. And so I think, there's an opportunity for us to learn from East Africa and Kenya on how we can begin to implement green bonds in our market to, again, just to provide that additional incentive. And Madeleine, I think you mentioned the renewable energy incentives in South Africa. And that'll be my last point on this question is, with the high energy demand in Zimbabwe, I think there's a lot more we could be doing to incentivize renewable energy, specifically solar. South Africa has made significant progress now. I can't remember the specific, I think it might be 40% now renewable energy contribution in terms of total energy output. But for Zimbabwe, I think there is an opportunity there where it makes commercial sense. When we look at the numbers, the average price of power, average import price maybe is about 18 to 19 cents, or ZESA price, 18 to 19 cents roundabout. But, as Cicada Solar, we're implementing solar projects where, within the first 8 years where you've got the financing cost, you can bring that solar cost down to about 10 cents. And after you've paid off the financing, your energy cost could drop to possibly as low as 3 cents. So commercially, the numbers make, are incentive enough, but the upfront cost of implementing it requires us to have some level of policy incentive, whether it is special allowances or tax deductions. I think South Africa allows 100% allowance in the first year that you implement your solar solution. So these are some of the mechanisms that we can adopt.
Thank you so much. And I'm so happy we have our regulator who can push some of these initiatives that you are suggesting on stage. And I hope, Pascal, you're noting so that we can engage as accountants, for some of these benefits that we can get if we move forward. Maybe I'll just give you one last question. How does Cicada balance the tension between short-term profit and sustainability? And can you share an example and lessons that have emerged?
Okay, so I think in addition to the solar lesson, that for us is very real. We've seen the impact on our estates where we've started implementing solar. But, sustainability is hard and it comes at a cost. And one of the things we began to do was adopt integrated pest management, where we are intentionally looking at reducing the amount of chemicals that we are applying on our estates and intentionally now measuring our EIQ, environmental impact quotients. One of the things we've done in terms of biological controls is to introduce wasps in our avocado plantations to help us manage stink bug. And so over the last 2 to 3 seasons, we've gradually been increasing the amount of hectarage that we are applying biological controls. It has come at an additional cost. And now, coupled with global pricing having gone through a slump, it was almost a double penalty because you had the incremental cost of doing the right thing, biological controls, but then the double effect of global pricing not responding upwards and in fact going in the opposite direction. And so these are some of the things where you are trying to make that balance between profit and sustainability, but our view as a business is that we're taking a long-term view on sustainability. And that means sustainability is embedded in our strategy right from board level, where we've got a sustainability subcommittee. Our strategy is driven and focused with sustainability at the core of that, because we're not looking at where we are today or in 5 years' time. We're trying to see how we can be stewards of a business that can exist and be prosperous for the next 50 years plus. So if you're going to get into sustainability, you definitely need to be prepared to have that long-term view on growth.
Thank you so much. You've really brought out how ESG creates value, but I like how you're stressing that as much as it might be painful now, we need to have a long-term view. So, Fungai, do you think our professional training systems are evolving fast enough to support the kind of real world implementation? I think there are a lot of initiatives that Karen spoke about that I was thinking, do our recently qualified CAs think like this and think long term and think about how we can influence the adoption and particularly also influence the value that even comes from adopting ESG practices?
Thank you, Hope. And I think when I'm looking at this, sustainability is a huge thing. Too huge for PAB alone, because we are just but 1 sector in terms of us regulating accountancy professionals. So the good thing is, everyone's heart is where their money is. So I guess we are a good starting point. But already in our process, because SPAB, we are in the process of finalizing our sustainability roadmap. And what we have realized is it's not something that only accountants can do by themselves. This definitely needs all the different other regulators. But I'm glad that in our country, there is that realization that we need to deal with sustainability issues, hence the advent of institutions like the Environmental Management Agency, realizing that there are areas that we need to look at. However, be that as it may, from accountancy perspective, at the moment, the international education standards have actually been modified to include these sustainability aspects. And this is something that we are monitoring very closely. So, this is at professional level. And when we are embedding this, it's not just about how do you do the disclosure, it's about how do you deliver value. There's a lot that has changed in the education space of accountants, and it goes beyond just the numbers, but to delivering value as well. So our international standards have changed to accommodate that, which are the standards that we adhere to here. However, we've had a challenge where there's been like a divorce between what happens at a professional level and what happens at a grassroots level. Because some of these things, we need to impart them in someone over time. It's like ethics. Someone was saying, accountants, you think you can teach ethics, but I think it's about how our training is designed, which makes sure that ethics is like a part of someone. So that is the same thing that we are doing with sustainability. And we are going down not just at professional level with our constituent bodies, but even to the universities. So the good thing is we now have a relationship with the Ministry of Higher and Tertiary Education so that we can influence more in terms of the curriculum and what our future leaders will be learning with regards not just to accounting, but sustainability as well.
It's refreshing to know that we're starting quite low and we're not just trying to teach someone once they've qualified. Of course, CPD helps, but I think the PAOs can agree, or even the members logging the CPD can be quite a bit of work. So maybe from a different view, stakeholders often distrust ESG reports. I think Elvis spoke about how Shane had to pay some penalties. There have been a lot of stories about companies reporting that, you know what, we are ESG compliant, we're doing this and that. How can PAB use its oversight and education mandate to close this trust gap and improve assurance quality?
All right. Thank you, Hope. So, with regards to trust of these reports, I think in Zimbabwe we have a unique situation where generally not just sustainability reports, but lately people have not been seeing value even in the normal financial reports because they cannot understand them. So what we are doing from our end is, especially with regards to sustainability and how technical it can look, an ordinary person might struggle to understand these things. So we have realized that we need to do a lot of capacity building, particularly on the assurance side, to make sure that our auditors, we are also confident that our auditors know what they're doing in this regard. And we've also noted the fact that as accountants, they might not be able to provide full assurance of everything that is contained in those sustainability reports. So, this is something that we're looking at to see how we can work together with experts like Karen and Madeleine to in the assurance value chain to say these figures are accurate. These reports are indeed accurate. So we are looking at capacity building. Similarly to Kenya, we will also start with limited assurance until we go to reasonable assurance, because we realize the gap that is there that we need to close up. Yeah.
Okay, thank you. Maybe just to close, the final question, you're talking about assurance, but even from a reporting issue, I think we've been hearing consistently throughout the day that data is an issue, capacity is an issue, skills are an issue. So do you believe PAB should push for ESG disclosure standards now? Or should we wait for global convergence before acting locally? Or what do you suggest in that regard?
So on this one, the Minister of Finance already said we are adopting sustainability standards. But anyway, be that as it may, um, we cannot afford to wait. We can see where the rest of the other countries are going, our neighbors, South Africa, Kenya, and all the other ones, where they are going. I think as PAB, we are watching closely. Where we need to make any adjustments, we will we will look into that, but we can only make those adjustments once we see how the implementation goes. So we need to start. If you are going to benefit from everything that Karen is talking about, we need to already start the implementation now. What we realize that we will not be able to do the full implementation as a start, because it's a journey, it's a marathon and not a sprint. So we are giving certain exemptions as a start, but we need our entities to start thinking about this, to start taking this serious until we reach full implementation.
Thank you so much, Fungai, and thank you for the audience for paying attention, although it's way past lunchtime. Thank you for the rich and candid insights. And what's clear from the conversation is that ESG leadership is no longer a communication issue; it's a governance and strategy issue, and you've all really stressed that. So, if anyone has any burning closing remarks, I'll give you 30 seconds if you've got something to add. Okay, thank you. I'm sure the audience can put their questions on the link that Pascal was talking about, and in the afternoon session, we will address the questions. Thank you so much.